Are you looking to make big gains in the stock market this year? Options trading may seem like an attractive option, but is it worth the risk? Join us as we weigh the pros and cons of trading options in 2023 and help you make an informed decision. Investing your money is a crucial decision that requires careful consideration. Options trading is a complex investment strategy that offers potential high returns, but it's not without its challenges. Before jumping into options trading, it's advisable to acquire some trading experience and a solid understanding of how the process works. To help you navigate the world of options trading, we put together a comprehensive guide outlining the pros and cons of this investment approach. We'll also provide you with some simpler alternatives, so you can make an informed decision about the best investment strategy for your needs. So sit back, relax, and let's dive into the world of options trading. Options contracts are a unique financial instrument that allows investors to buy or sell a stock at a specific price if they choose to do so before the contract's expiration date. Each option contract is made in increments of 100 shares, so if you purchase one option contract, it grants you the right to buy or sell 100 shares of the underlying stock. It's important to note that options contracts differ from the stock options that some employees may receive from their employer. Options trading is a more advanced investment method than stocks or mutual funds, and traders can develop various strategies to leverage options to their advantage. These strategies can help traders limit the risk with a specific stock, increase their income if they're the seller, and plan for the future. So, if you're willing to take on the challenge of learning this sophisticated investment technique, options trading may be a valuable addition to your investment portfolio. In the world of options trading, there are two main types of options: call options and put options. Understanding the difference between the two is crucial for any trader looking to invest in options. Call options. When buying a call option, you're purchasing the right, but not the obligation, to buy a specific stock at a predetermined price, known as the strike price, on or before the expiration date of the contract. However, when selling a call option, also known as a covered call, you agree to sell the stock at the strike price to the buyer if they choose to exercise their option. As the buyer of a call option, your hope is that the price of the stock will increase above the strike price. For instance, if you purchase a call option for $20, giving you the right to buy 100 shares of Apple stock at a strike price of $160 per share, assuming that you purchased a call option for a stock at $160 per share, and the stock price rise is to $200 within the specified time frame of the option contract, you have the option to exercise it and realize a profit of $4,000. You'll lose the cost of the options contract, which is relatively low. On the other hand, if you're the seller of the call option, your objective is to ensure the stock price either stays the same or drops. In the above scenario, if the stock price rises to $200, you'll be obligated to sell the stock at a $40 discount per share, leading to a loss of $4,000. However, if the stock price remains the same or decreases and the buyer doesn't exercise the option, you'll keep the $20 premium. As you can see, the decision to buy or sell a call option has its advantages and disadvantages, and traders need to weigh the risks and rewards carefully before committing to any trade. Put options. If you're buying a put option, you have the right but not the obligation to sell a stock at a specific price within the specified time frame. If you're selling a put option, you're agreeing to buy the stock at the strike price if the buyer chooses to exercise the option. As a buyer of a put option, you're hoping that the price of the stock will decrease. For instance, suppose you buy a put option for $25, giving you the right to sell 100 shares of Apple stock at $160 per share. If the stock drops to $140 and you exercise your option, you can sell the shares to the put option seller for $160 per share, which means a profit of $2,000. Comment trading to see more videos on trading. On the other hand, if you're the seller of a put option, you're anticipating the stock price to rise. If the price of Apple's stock remains at or above the strike price of $160, the put option buyer won't exercise the option, and you can keep the $25 premium. Investing in options can offer several benefits and drawbacks. which is important to consider before including them in your investment strategy. One of the significant advantages of using options is that it requires a lower financial commitment, allowing investors to take advantage of the price movement of a stock without having to invest in actual shares. This can result in a higher potential return compared to the initial investment. Additionally, options offer less downside for buyers as they are not obligated to buy or sell the underlying stock in the contract, limiting their potential loss to the contract premium. Furthermore, options provide more flexibility with trading, enabling investors to use various strategies to achieve their investment goals, such as hedging their current investments or earning extra income from stock they already own. Options can be a complex investment strategy that requires a thorough understanding of their unique terminology and regulations. As such, it's important to have a good deal of experience and knowledge before attempting to trade options. Additionally, options have the potential for high losses, particularly for sellers who may incur significant losses beyond the premium they receive. Finally, trading options aren't accessible to everyone, as brokerage firms require approval and a minimum cash reserve of $2,000 to get started. If you're new to investing, it's important to consider your options carefully before diving into something as complex as options trading. Fortunately, there are plenty of other investment opportunities available that may be easier for beginners to understand and manage. Some alternatives to options trading that you might want to consider include investing in stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate investment trusts, REITs, or even cryptocurrencies. Consulting with a financial advisor or investment planner is also a wise choice if you're uncertain about whether options are the right investment strategy for you. A professional can provide valuable insights and guidance about how to effectively incorporate options trading into your investment portfolio and manage any associated risks. Before making any investment decisions, it's always a good idea to do your research, consider your financial goals and risk tolerance, and seek professional advice if necessary. So that's it today for you guys. Hope you liked the video. If you liked the video, don't forget to like, share, subscribe, and comment on your investing experience. We hope to see you in our next video. Ciao.